Picture the scene in your mind for a second. It's New Year's Day, 2002. Across 12 European countries, people are lining up at cash machines in the cold winter dark, sliding in their old bank cards and, for the first time, pulling out crisp new banknotes with strange bridges and windows on them instead of familiar national symbols. In a matter of weeks, more than 14 billion euro banknotes and over 50 billion coins will replace francs, marks, lira, pesetas, and all the rest in what the European Central Bank still calls the largest cash changeover in history. On the surface, it looks like a pure political story about peace, unity, and a shared European identity. But if you look a little closer at who pushed hardest for this project, who shaped its rules, and who got rescued when things went bad, a different story starts to emerge. A story where big banks, industrial giants, and corporate lobby groups quietly turn a currency experiment into a machine for shifting risk downward and profit upward. To get a handle on that story, we need to rewind a couple of decades, back to the late 1970s and 1980s. Europe was already integrating. The old European economic community had built an internal market for goods, but money was still messy. Each country had its own currency, and they lurched around against each other every time there was a crisis, an oil shock, or a speculative attack. Governments tried to tame the chaos with the European monetary system in 1979, fixing exchange rates within narrow bands, but it was always creaking. If you were a big manufacturer selling across the continent, that meant constant hedging, constant paperwork, and a never-ending currency headache. And by this point, Europe had plenty of very big manufacturers. In 1983, a group of CEOs from companies like Volvo, Philips, Nestlé, Siemens, and Fiat quietly formed something called the European Roundtable of Industrialists, now known as the European Roundtable for Industry. It was, and still is, a club of around 60 top bosses from huge multinationals, explicitly set up to push for a more unified European market, better infrastructure, and rules that suited large cross-border firms. The Round Table supported the single market, supported deeper integration, and crucially, supported monetary union. From their point of view, a patchwork of currencies was an annoying relic. What they wanted was one big, frictionless home market. But even the Round Table wasn't the sharpest spear point for the single currency. That role fell to a more focused pressure group that almost never makes it into the high school version of the story. The Association for the Monetary Union of Europe, or AMUE. Founded in 1987 in Turin, AMUE brought together hundreds of Europe's largest multinationals and banks. Names like Philips, BP, Volkswagen, Fiat, Alcatel, Solvay, Deutsche Bank, Dresdner Bank, and Commerzbank. Its whole purpose was to campaign for a single currency. It held conferences, commissioned research, and created a space where pro-Euro politicians could mingle with corporate leaders who had a lot to gain from making borders inside Europe feel financially invisible. Researchers who've dug into AMUE's archives and interviewed its leaders describe something interesting. They found that these business leaders understood the technical side of monetary union well enough to know that a single currency without some sort of shared fiscal capacity, like a strong common budget or Eurobonds, would be fragile. They were in close contact with people like Alexandra Lamfalussy, one of the intellectual architects of the euro, and they knew the textbook argument that a stable monetary union usually needs a central fiscal backstop. But they also knew that if they publicly campaigned for that kind of full union, the whole project might die under a wave of opposition from German conservatives who feared a transfer union and from British and French politicians who didn't want to give up budget sovereignty. So they made a tactical choice. Push hard for the currency, stay quiet on fiscal union, and accept strict rules and an independent central bank to calm German fears. It was a narrow path, but it was the path that gave them what they wanted most: one currency. Behind the scenes, this corporate push sat alongside a much older, quieter network, Europe's big bank elite. Since 1951, the CEOs of major European banks had been meeting in a private club with an academic-sounding name, the Institut International d'études bancaires. It has no public membership list, no real website, and holds closed-door, 3-day meetings twice a year in places like Vienna or at Chateau Estates outside Paris. Central bankers have gone there to give speeches. One Dutch central bank chief even spoke there specifically about monetary unions in Europe and the United States. That doesn't prove there was some secret Euro plot hatched in smoke-filled rooms, but it does tell you that Europe's top bankers and the officials designing the monetary union were moving in the same small exclusive circles long before ordinary voters saw a single euro coin. On the official stage, the story looks cleaner. In 1988, European leaders asked the President of the European Commission, Jacques Delors, to chair a committee on how to achieve economic and monetary union. The Delors Committee's report in 1989 sketched a 3-stage path to a single currency, including full liberalization of capital flows, closer economic policy coordination, and the creation of an independent European central bank. Those ideas fed straight into the Maastricht Treaty, signed in 1992, which legally committed the then 12 member states to the long march toward a single currency. The euro itself was born on 1 January 1999 as an electronic and accounting currency, invisible money used in bank transfers and financial markets. Only in January 2002 did the notes and AMUE coins arrive in people's pockets in those first 12 countries, from Germany and France to Greece, Ireland, and Portugal. The architecture that came with the euro was very specific and very friendly to creditors. The new European Central Bank was made independent, with a primary mandate to keep inflation low, not to chase maximum employment or finance governments. And the Maastricht rules, later reinforced by the Stability and Growth Pact, said that national budget deficits were supposed to stay below 3% of GDP and public debt below 60%. Those limits weren't just abstract, they were hardwired into how financial markets judged countries and how Brussels monitored them. For governments, that meant less room to borrow and spend when unemployment was high. For big lenders, banks, insurers, pension funds, it meant stronger protection that the bonds they held would be backed by governments constrained from printing their way out of trouble. Supporters of the euro saw this as a virtue. Critics, including some economists and journalists looking back on the project, have argued that this was precisely the point: a currency design that takes key economic levers, interest rates, exchange rates, much of fiscal policy, out of the hands of elected national governments and locks in an environment where deregulation, privatization, and welfare cuts become the default responses to crisis. One high-profile critic of the euro's intellectual father, Robert Mundell, portrayed him as favoring a system where governments could no longer easily stimulate their economies, forcing through more market-friendly reforms instead. Whether you agree or not, it's a reminder that the way the euro was built lined up very neatly with the wishes of large creditors who fear inflation more than they fear mass unemployment. Once the euro actually arrived, the payoff for big business was immediate and very concrete. Firms selling across the continent no longer had to worry that a sudden devaluation in Italy or Spain would blow a hole in their margins. Academic studies have found that the introduction of the euro significantly reduced foreign exchange risk for non-financial companies, both inside Europe and for foreign firms with lots of sales or assets there, with the largest reductions for companies based in the eurozone itself. At the same time, putting everything in one currency made prices more transparent. A car maker in France could see at a glance if components from Slovakia had become cheaper than those from Germany. Textbooks and EU reports point to lower transaction costs, easier price comparison, and a boost to intra-European trade as some of the main economic benefits of the currency. Those same forces reshaped Europe's financial system in ways that mattered hugely for banks and large corporations. The euro basically glued together what had been a patchwork of national bond and money markets into one much larger securities market. Research summarized by the European Central Bank notes that the currency significantly reshaped Europe's financial system by integrating bond and equity markets, cutting the cost of trading financial assets across borders, and making it cheaper for companies to borrow. Wholesale banking, the big money end of the business, became much more integrated even while local retail markets stayed more fragmented. For a big corporation with operations in 10 countries, instead of issuing a bond in lira, another in marks and another in francs, it could tap one deep euro-denominated pool of capital, underwritten by banks operating at a continental scale. You can see how attractive that pool has become by looking at who else is using it. In recent years, there's been a boom in so-called reverse Yankee bonds, U.S. companies borrowing in euros on European markets. By 2025, U.S. firms like Alphabet, Visa, PepsiCo, and Verizon had issued around $100 billion worth of euro-denominated bonds in a single year, a record, taking advantage of lower interest rates in the Eurozone compared with the United States. The existence of that market is itself a quiet testament to the success of the euro in creating a huge, liquid capital pool. The banks arranging those deals, the investors collecting the interest, and the multinationals that can pick and choose their cheapest funding source are obvious winners of the currency union. Under the surface, the plumbing of payments was also rewired in ways that mattered more to bankers than to tourists buying gelato. The Single Euro Payments Area, or SEPA, turned 41 countries into one integrated zone for euro transfers, promising that a cross-border transfer in euros would be as cheap and fast as a domestic one and banning banks from skimming extra fees off the top. That's a huge efficiency gain for businesses moving money around the continent, and it created the foundation for new payment schemes like the European Payments Initiative's Wero digital wallet, a project backed by major European banks to offer instant account-to-account payments as an alternative to global card networks. For consumers, that might mean a new way to pay with your phone. For the banks designing the system, it's about controlling the rails of Europe's digital money and the fees that flow over them. So far, this all sounds like a story of legal, above-board integration. The dark side of the euro emerges when you look at how some players learned to game the rules and at how the system responded when the first big crisis hit. A classic example is Greece's entry into the Eurozone. To qualify under Maastricht, a country was supposed to have a deficit below 3% of GDP and debt below 60%, or at least moving convincingly in that direction. Greece's numbers were, to put it politely, a stretch. So in 2001 and 2002, the Greek government worked with Goldman Sachs on a series of off-market currency, swaps, complex derivatives that, thanks to fictional exchange rates, allowed Greece to effectively borrow billions of euros while making a portion of its debt vanish from the official statistics. Journalistic investigations and later official reports suggest that Goldman may have earned on the order of 600 million euros in fees from a structure that reduced Greece's reported debt by roughly 2.3 billion euros, about 1.6 percentage points of GDP, at the stroke of a pen. What made that deal so controversial wasn't just the profit. It was the opacity. Eurostat, the EU's statistical office, later said it only became aware of the full details of these kinds of swaps years after they were done, even though specialist financial publications had written about them. Bond investors buying Greek debt at the time saw official numbers that understated the country's real obligations, while the banks arranging and trading the swaps had a much clearer picture. Some market participants later complained that if a bank knew the data in the prospectus was incomplete and didn't disclose that, then investors had effectively been fooled. Here again, the structure of the euro, strict debt rules, lots of pressure to converge on paper, created a lucrative niche for financial engineering that benefited Wall Street and European banks while leaving ordinary Greeks with the bill when those hidden liabilities came due. But the biggest single transfer of risk in the euro story came not from any one derivatives deal, but from the way capital flowed before and after the 2008 global financial crisis. In the early years of the euro, interest rates across the bloc converged. Countries like Spain, Portugal, Ireland, and Greece, often grouped together as the periphery, could suddenly borrow in the same currency as Germany at only slightly higher yields. Banks in the core countries, particularly Germany and France, poured private capital into the periphery, financing housing booms in Spain and Ireland, government borrowing in Greece and Portugal, and a general surge in cross-border lending. A study from the Federal Reserve Bank of San Francisco traces how, before the crisis, private capital flows from the core to these GIPS countries neatly matched their rising current account deficits. When the global crisis hit and then morphed into the euro area debt crisis, those private flows didn't just slow, they slammed into reverse, a classic sudden stop. Ratings agencies slashed the sovereign ratings of Greece, Portugal, and Ireland, bond yields spiked, and investors fled. Normally, a country in that situation would devalue its currency, making its exports cheaper and resetting the system. But Greece and the others no longer had their own currencies. So instead, something more subtle happened. The Eurosystem's internal payments network, Target 2, and later official bailout funds stepped in. As private capital left, the deficits were financed increasingly by rising liabilities that the periphery's national central banks owed to the European Central Bank and to core country central banks, showing up as huge Target 2 imbalances. Public money quietly replaced private money. In Greece's case, researchers have tried to follow that trail more precisely. One widely cited study, summarized in the literature on the euro crisis, found that between early 2010 and late 2011, Greek public debt owed to foreign governments and European institutions jumped from about 48 billion euros to 180 billion, while foreign banks' combined exposure to Greek borrowers, public and private, fell from well over 200 billion euros to around 80 billion. By 2015, roughly 78% of Greek government debt was owed not to private banks, but to official sector bodies, EU rescue funds, the ECB, and the IMF. And when analysts at the European School of Management and Technology dug into where the money from the first two Greek bailout packages actually went, they concluded that less than 5%, under 10 billion euros, ended up in the Greek government's fiscal budget. The overwhelming majority went to repay or service existing debts, much of it to French and German banks and to other financial institutions. In plain language, the bailouts stabilized the Eurozone's financial system by moving bad loans off the balance sheets of private creditors and onto the shoulders of European taxpayers. For people living in Greece, Portugal, Spain, or Ireland, the experience from 2010 onward was not one of being rescued in any everyday sense. It meant austerity programs, wage cuts, pension reductions, and years of double-digit unemployment. For the big banks that had overlent into those markets, the euro architecture and the political determination to keep the single currency together at almost any cost meant that most of their loans were ultimately repaid, or at least their worst losses absorbed by the public sector. That's not an accident of history. It's how a system built to protect the stability of the currency and the claims of creditors behaves when push comes to shove. Zooming out, there's also the quieter, ongoing advantage that the euro gives to Europe's strongest export machine, Germany. Exports make up just over half of German GDP, and the country ran a trade surplus of roughly $255 billion in 2024, one of the largest in the world. Analysts have long noted that the common currency is, in effect, too weak for Germany's hyper-competitive industrial economy and too strong for some weaker members. A 2017 analysis drawing on purchasing power data suggested that a hypothetical German euro was nearly 17% undervalued against the dollar, while a French euro was slightly overvalued and a Greek euro even more so. Around the same time, Germany's own finance minister, Wolfgang Schäuble, acknowledged that the euro exchange rate was too low for the German economy's competitive position, essentially admitting that ECB policy aimed at shoring up weaker states had the side effect of turbocharging German exports. For big German manufacturers famous for selling cars, machinery, and chemicals worldwide, that's a structural gift. A currency that stays cheaper than the old Deutsche Mark almost certainly would have. That doesn't mean every German is a winner or that every euro member gained. Economists Laura Pucello and Pedro Gomes Porqueras used a sophisticated synthetic control method to estimate how 6 early adopters of the euro would have fared without it. Their results suggest that per-person income in Belgium, France, Germany, and Italy would actually have been higher without joining the monetary union, while Ireland would have been substantially poorer and the Netherlands roughly unchanged. The benefits of the euro are very uneven, and they tend to concentrate in the sectors and countries best positioned to exploit a vast, stable market: big exporters, large multinationals, and financial institutions. Meanwhile, within Brussels, the ongoing rulemaking around the single market in the euro area has been heavily shaped by organized corporate voices. Business Europe, the Confederation of European Business, represents national industry federations and, through them, about 20 million companies across 36 countries. It's widely described as one of the most powerful lobby groups in the EU, consulted on everything from trade policy to labor law. In the narrower world of finance, a Paris-based association called Eurofi brings together more than 100 major financial firms and organizes closed-door, high-level seminars where bank CEOs and EU regulators debate monetary and regulatory issues away from cameras. The Financial Times has called it the think tank at the heart of the EU, while also criticizing its lack of transparency and the way its agenda tends to mirror the priorities of the financial industry. Add to that the secretive bankers club we met earlier, the IIEB, which quietly hosts central bankers to talk about exactly these issues, and you start to see a dense ecosystem of corporate and financial interests that has had a front-row seat as the euro's rules have been written and rewritten. There have been attempts to build counterweights. After the crisis, for example, members of the European Parliament helped launch Finance Watch, a Brussels-based NGO explicitly designed to give citizens and consumer groups a voice in debates dominated by the financial lobby. Organizations like the European Small Business Alliance try to speak for entrepreneurs and the self-employed, but the balance of resources is lopsided. When you have an industry lobby like Business Europe or a bank-driven platform like Eurofi sitting across the table from EU officials on a monthly basis, with teams of lawyers and economists, and ordinary citizens only dimly aware of how target balances or bank capital rules work, it isn't hard to guess whose preferences tend to dominate, and the story isn't over. The European Central Bank is now deep into preparations for a potential digital euro, a central bank digital currency that would exist alongside cash and bank deposits. The ECB finished a 2-year investigation phase in 2023 and moved into a preparation phase to design the rulebook and pick the technology providers, aiming for possible launch around 2029 if EU lawmakers give the green light. Publicly, the project is about giving citizens a safe, modern payment option and reinforcing monetary sovereignty. Behind the scenes, it's also about deciding exactly how much of that new payment layer will run through private intermediaries like banks and payment processors, and how much will be direct. Given the track record of the last quarter century, it's a safe bet that Europe's largest financial institutions will work hard to ensure that whatever form the digital euro takes, it doesn't sideline them. So when you pull all these threads together, the business lobbies that campaigned for the euro, the way the rules were written to prioritize price stability and fiscal restraint, the derivatives deals that bent those rules in the shadows, the capital flows that boomed and then were quietly socialized during the crisis, the ongoing structural advantage for export powerhouses like Germany, and the dense web of financial lobby groups and elite clubs shaping today's debates, you get a much more complicated picture than the simple Europe united under one money story. The single currency did bring real benefits. You can travel from Lisbon to Helsinki without changing cash. Small firms can sell online across borders more easily, and for many people the euro is part of their identity now. But if you follow the money, who pushed hardest for this project, who got their risks underwritten, who gained cheap funding and a shield against devaluation, the center of gravity of the benefits sits very clearly with large corporations and banks. That's what people mean when they talk about the dark money behind the euro. Not necessarily bags of illegal cash changing hands in back alleys, but long-term sustained influence. Lobby groups like AMUE making the intellectual case, industrial roundtables drafting the wish lists, global investment banks designing clever ways around the rules, and when the storm finally hit, rescue operations that focused first on stabilizing balance sheets at the top of the system, with the social costs largely borne by ordinary citizens. It doesn't make the euro a pure villain or a pure hero. It makes it what it really is, a political and financial project whose winners and losers were never evenly spread. If you want more deep dives into the hidden economics behind big historical turning points like this, who really pulled the strings, who paid the price, and how it still shapes our world today, let me know by hitting like. Share this with a friend who loves this kind of thing, and make sure you're subscribed to History and Today so you don't miss the next episode.